Welcome to the second Financial Policy Council event of the year. We're going to have 7 events this year. I hope I will see you and many more attending all of our events. This is a very unique event, and we'll go over it in a while. Let me tell you a bit about the Financial Policy Council for all the new attendees here, for those who never attended our previous events. This is not just a 501c3 organization. We are a movement of capitalists, of patriots, of game changers who are rocking the boat every day. Our mandate is to empower people, inspire people, and lead them to the right way where they can make fuck you money. Very simple. We're not going to mince our words. This is all capitalism, patriotism, and the way you achieve that is by educating and empowering people. Educating them to the truth, not to the bullshit out there, not to the propaganda, the media, the brainwashing, and all that bullshit. We talk the truth, and the only way you win is by knowing the truth. Business for us is war. This is not a walk in the park, a 9-to-5 job where you're complying to some idiot out there who doesn't know what he's talking about. It's war. Now, you know how you win wars? You don't win wars because you're the smartest one. No. There are a lot of smart people out there, and they're not necessarily winners. You don't win war because you're the richest one, or you have the biggest balance sheet. No. From my experience, you win war by gathering intelligence second to none. Look at the Iraq War. We went there, lost 6,000 lives, $8 trillion based on wrong intel, based on a vendetta. And every time you have a wrong intel, you're going to fuck up because you don't have the real information, because you're striking blanks. So you really got to know exactly what's happening out there. And I'm talking about every single asset class, not just fintech, Bitcoin, blockchain, healthcare, oil and gas, real estate. No, every single asset class. You have to be a walking encyclopedia of true information. And the only way you get access to true information is not through the media, because they have their own agenda, or your professor, or anything like that. The only way you access this information is through people entrenched in their respective fields, who have skin in the game, who take risks every day, and who know how to operate. And this is the purpose of the Financial Policy Council, is to introduce people to others of the same caliber who know what they're talking about. And this is how you're going to make the best decisions, and you're going to make fuck you money. And money, once again, let me repeat, it's not about we love money, we're greedy. No, no, no. It's not about showing what you have, your car, your yacht, your plane, your house. No, no, no. Money is about freedom. That's all what it is. The more money you make, the freer you're going to become. And you're not going to take shit from no one, neither your boss, nor a senator, nor a congressman, nobody. You don't need them, they need you. For me, my only boss is money. I don't report to anyone. And you want to be in a position where your only boss is money. So you are free, independent, opinionated, and growing some balls. Because this is what it takes to succeed today. And not being afraid of offending people because you use the F word. Fuck them. You know, there's nothing more impressive than somebody who's genuine, who speaks from the heart, who uses his brain, and who has common sense. The age of common sense is lost. Everybody's lost and don't know what to do, and they panic. And anything the government proposes to you, you do the reverse. That's my philosophy. Anything they say, they touch, they do is wrong. They're here to basically control you, manipulate you, brainwash you. They don't want you to educate yourself. They don't want you to be rich and powerful. They're not for small or medium-sized business. They want a bunch of corporate behemoths controlling your life and you working for them. And all these elite colleges, like stupid Harvard and others, they're here to create robots. Just shut up, do your work, you're a robot, you're a number, you don't make any difference. Well, you will never go anywhere with that. And look at the biggest rebels in capitalism who dropped from Harvard, who told you, fuck you, Harvard, from Mark Zuckerberg to Bill Gates to Steve Jobs to everybody. And that's how they became billionaires. So stop thinking that corporate job is security. Corporate job is slavery. Slavery. It's like the slavery 200 years ago in the plantations. The same thing today, having a job in corporate America. This is the truth. Nobody wants to hear you to hear that. Nobody wants you to feel empowered to do that. I can talk for hours, but this is not the subject today. Today we have assembled a fantastic team of entrepreneurs who have succeeded, who are achieving every day, who are game changers, who are changing the name of the game. I'm going to introduce each one of them. First, I'd like to thank a lot the sponsors of the event, Mbanq, led by Vladimir Lounegov, and Cheqly, led by Tom Milar. Thank you guys for your support. I also would like to thank the board of directors of the Financial Policy Council, the project liability team members, who are an essential part of all of that. All what we need, all what we want. When people ask me, what do you want you guys, your legacy to be? All what we want is to create an army of millionaires and billionaires. To tell anybody who comes against you, starting with the government, go fuck yourself. We don't need you. That's it. It's very difficult. Not very difficult. To do that, you have to access to the information from people entrenched with skin in the game, not from any propaganda out there. Anyway, having said that, I'd like to start with each one of you panelists. If you could talk a couple of minutes about yourself, your background, why you're here, and then we can delve into the question and answers. The way it works, being the moderator, I will ask them a couple of questions each, then I will turn it to you, the audience, to ask them any questions you want. And make the questions difficult, grill them. There's no stupid question, there's only stupid people. So you can ask them any questions you want, because at the end of the day, if you're not out of this event saying, wow, I really learned something today, this is incredible, we would have failed in delivering what we are trying to deliver to you. This is a shock and awe. You ask them very difficult question, there is no stupid question. You're here to learn, to be empowered. And these are the experts. So I'll start with Vladimir Lounegov. Go ahead, Vladimir.
By the microphone. Well, first of all, thank you very much, Ziad, and thank you very much, Financial Policy Council, for having us here. This is my second event, and I've been with Financial Policy Council for as long as I can remember, starting years ago with the Entrepreneurship Award. Thank you very much, Financial Policy Council, and ever since then I've been a great supporter of the cause that is led by Ziad, but also the education that we bring to the masses. And just like myself, my co-founders, Lars and others, when we founded Mbanq, we also wanted to break away from the corporate America. I spent years in consulting, about 15 years in consulting, and by the end of my consulting career, and I spent most of my time in 3 out of the 4 big 4 firms, starting with KPMG, EY, and then PwC. I realized at some point in time that we've been trying to persuade clients to switch from, let's say, one core banking system to another, and both of them were old and antiquated, and we were trying to position one as better than the others. So I thought there must be a different way. Lars and others, we all thought there must be another way, so we got together and founded Mbanq. And ever since then, I don't want to say that we've been working towards fuck you money, but I can tell you that this is a more or less of a guiding principle, because we don't want to work for anybody. We want to be entrepreneurs. We want to embrace entrepreneurship. We want to educate people who join our company to be entrepreneurs. They need to own something. If they join a company looking for a 9-to-5 job, then perhaps Mbanq is not the right environment for them. But if they join looking for something that they can actually own and deliver and be responsible for, if they win or fail, either way, right, then this is the kind of environment that we give them. Thank you.
Thank you very much, Vlad. Lars Rottweiler, go ahead, Lars.
So thank you, Ziad, for being here. And like Vlad already said, I'm the other co-founder of Mbanq. My career was a little bit similar to Vlad, and been in consulting, used to be partner at Accenture and PwC, went to Deutsche Bank as member of the board, as managing director, and had the same tragedy behind there. So there must be a better way. There's so many people in corporate roles, they go 9 to 5, even they go 9 to midnight, it doesn't change the thing. They work for someone, right? It doesn't matter where you are, you always have to be responsible for other people's wishes. And I met a lot of psychopaths in my life in those corporate worlds, and they never cared about the shareholder value, they never cared about the well-being of the company or the employees, they only thought about their own ego. And that let me go out of this corporate world, so that's my place to be. With Mbanq, we have a complete different style. We lead different, but most important, not only our employees are shareholders in Mbanq, but we have a lot of clients, and we enable young startups, seasoned entrepreneurs to have their own bank, have their own financial institution, and to give them the freedom you're all looking for. So happy to be here and looking forward to your questions.
Thank you, Lars. Steven.
Thank you, Ziad. My name's Steve Williams. I'm CEO of a company called Qorbis. We're actually a customer of Mbanq. My background is long history in financial services. In fact, I started with Dean Witter, which is a good Wall Street firm or Chicago firm, many, many years ago. So that was on derivatives and trading, and had a long history in financial services. And then along came in around about 99 for me, a little earlier for other people, this wonderful thing called internet, and we call it internet or .com, 1.0. And it was transformational. It was like Big Bang 2. I mean, it was just an amazing journey. So I got into tech, and then at a certain point, there was an intersection between financial services and technology, and that's what we now refer to as Fintech. And to follow from what Lars just said, we're talking about being entrepreneurs, we're talking about entrepreneurialism, providing innovative, intuitive tools to assist entrepreneurs really from the sort of fintech angle, but assisting them in realizing their goals is not only a great opportunity, but it's a great engine for growth, because the fact is that most economies are made up of SMBs. In aggregate, SMBs account for a very significant part of GDP and employment, and traditionally they have been underserved by large corporates who just want their dollars. They just want fees. Okay, but I think if you empower entrepreneurs with innovative tools, that's the name of the game, and that's where Qorbis sits.
Thank you, Stephen. Tom?
Hello, everyone. My name is Tomas, Milar. I'm founder of Cheqly and Equista. And my life was always different than anybody else's. So I started in Brussels 2008. So I was working for a lobby group for roughly 2 years, and I just couldn't stand back then the European Commission, because it was really slow and super slow. So I moved to Beijing for 1 year. Then I took a train. I paid $50. I was saving money back then. I moved to Hong Kong. I spent 10 years in Hong Kong. I built multiple companies. I sold a few of them. Then I moved to United States. I acquired a few companies. And I was lucky that I met many amazing people who supported me on the way. So we focus on equity. So we are one of the largest private stock issuer or administrator in the United States. Then we built one of the largest equity valuation team and the 409 evaluation provider. And thanks to Mbanq, we also built a neobank called Cheqly. We'll talk about it a little bit later. And what we do and what we want to do is very unusual, but we'll get back to that point a little bit later. Thank you, Ziad.
Okay. How much under management you have today?
We have $50 billion asset under administration. Is not under management.
How much? 50 billion?
50 billion.
Nice.
Yeah, 50 billion.
That's
and we would like to capitalize on that because it's an asset which is untapped, and we are coming up with a few business models which we would like to and products we would like to deploy. That's it.
Thank you. Hail to the entrepreneurs. Let me start with Vladimir. Vladimir, can you give me more insight into the recent bank failures? What happened and why did it happen? From Silicon Valley Bank and others.
That's a good question. So let's start with Silicon Valley Bank.
Yeah.
Actually, it was only about a month ago that we remembered the passing of Silicon Valley Bank the way that we used to know it. And for us, for Mbanq, it was a particularly difficult loss because they were one of our partner banks for third-party payment processing. We did about $400 million in transaction volume for third-party payment processing at the point of collapse of Silicon Valley Bank. And we were in the third quadrant of their depositors. So we were number 28 largest depositor with us and our clients with Silicon Valley Bank. So for us, it was a very difficult loss. And just like many people, I grew some gray hair, actually. I didn't know what was going to happen, especially with Mbanq. But we found our way out. Now, what actually happened now that we look back is that some of the smaller banks, and to be honest, Silicon Valley Bank was not the smallest bank. It was about $200 plus million in assets. They were quite exposed to interest rates, and because of the rising interest rates, and their balance sheet was not ready for long-term stability. And therefore, what happened with the regulator took a very decisive action. And myself, like many others, we thought, look, $200 billion is big enough a bank before the regulator could step in. And to be honest, nothing was too big or too small for the regulator. Yeah. So they decided to take some action. Now, that was not the only collapse that marked 2023. Obviously, we lost Signature Bank, and Signature Bank had a different issue. It was quite exposed to cryptocurrencies and crypto business in general. So it suffered from the FTX collapse, and we know other banks that we worked with that suffered from what happened following the FTX collapse. And then what followed after that, there was a period in time when bigger banks like Bank of America, for example, actually started doing pretty well. And our corporate deposits moved to Bank of America. And if you look right now, if you look at the statistics that they published this morning, Bank of America is now the largest depository institution in the United States. So they actually gained from it, quite a bit. Now, then came, of course, October-November timeframe when a lot of smaller banks that embrace banking as a service, which is something that we do at Mbanq, they started getting consent orders. So consent orders is basically a letter from the regulator that restricts certain activities or certain types of activities. And the board of directors of a financial institution need to consent to implement those orders. Now, at first, the orders that came in November timeframe, they were quite loose. They were basically saying, hey, you need to improve your corporate governance, you need to do this, that, and the other. But now they're very restrictive. And in fact, some of the banks, like, for example, Metropolitan Commercial Bank of New York, where we also had some of our relationships with, they decided to move away from banking as a service completely. So they don't support programs that we bring to market. So what actually happens, right? So what happens is that the regulator has become very heavy-handed, not only on banking as a service where we play, but also on the small and medium banks that the regulator now feels do not have either enough oversight or don't have enough knowledge of how the banking business works. Now, is this good news or bad news? I think overall it's pretty bad news because now you have big banks like Bank of America becoming even bigger. So that's not really the best news I think this country has seen. But on the other hand, it cleansed our industry quite a bit as well. So at Mbanq, we're focused quite a lot on compliance. So compliance as a service is our core value proposition. And because of that, we've been able not just to survive, but to flourish and grow through all those changes. So I would say that the collapse of Silicon Valley Bank was just a canary in a coal mine. And I think more banks, Lineage Bank is in trouble. It's a smaller bank, but it still works with fintechs. So those banks that will still continue perhaps to collapse or be merged or be forced to merge with bigger institutions. And then I think that for us, for entrepreneurs, we need to find a way and we need to make something out of it. So there we go.
Yeah, that's fine. Before I move to the next thing, I heard something recently. You know, what Klaus Schwab from the World Economic Forum says all the time, you won't have any money, you'll be happy, we'll take everything. What's happening today, before that we used to do bailouts. The government used to bail out these big banks. Today they're talking about bail-ins, meaning your stocks, your bonds, your cash is not owned by you anymore. It's owned by the creditor, the institution, the Bank of America type. So you really have nothing at this point. It's owned by the Bank of America type. This is absolutely revolutionary and disgusting. How do you evaluate this, each one of you or whatever? I mean, this is really happening.
So if you look at, so there's one bank that you guys might remember, First Republic Bank. So that's probably a similar situation. So without going into too much detail, there are some similarities.
We don't need to details.
Yeah, but they ended up. So they now trade. They still continue trading, but it now belongs to J.P. Morgan. So all of a sudden, a bank that had so much cash, right, because it was providing services to high net worth Silicon Valley entrepreneurs, right, all of a sudden it became J.P. Morgan. So it's unfortunate, but the big guys are getting bigger, right? And then community banks are suffering. Credit unions, I'm not even mentioning them. So the market is somewhat changing, and the big and strong are getting.
So
bigger.
we're moving more and more towards socialism.
Yes, maybe I wouldn't call it socialism yet, but we're literally firmly on track.
On track, okay. Excuse my French. Okay, I'd like to have a question for Stephen. Stephen, the next generation of business leaders are digital natives, okay? What strategies do banks face in adapting their services to meet the expectations of these demographics?
It's a very good question. You're absolutely right. I mean, I think the next generation, almost Gen Z, in the next decade, they will have all entered the workforce, the workspace, and they are just fundamentally different. They've grown up, mobile first. Like everything's on a phone, and they have no sort of time or patience for traditional sort of things like logging in, and it's painful for them. Yeah. So they want instant results, instant access, and that's what they expect. So I think we have to adapt. I mean, I've already noticed it. In the last decade, I was having a conversation earlier with somebody. I mean, when online banking came along, you'd walk into a banking hall, and they had like iPads bolted, to kind of like podiums, so that you couldn't run out of the door with the iPad. And the whole time, people were struggling to log into their accounts, and they'd have to call the assistant, and the assistant would help them. And actually, it turned out that was harder work than queuing up at the counter. But it's moved a lot since then, and definitely, I believe that this generation of business leaders, they have a very different expectation. And everything that we do now, anyway, is kind of on some form of tech platform. No matter what business you're in, you're reliant on technology. You can't avoid it.
Yeah.
And banking's no different.
Absolutely. Tom, how do you innovate the loan industry?
Yeah, so the innovation, that's actually what drives any business, right? Because if you launch any company, you need to come up with something new. So we have a launch in June, our Neobank, and we were looking for a unique proposition, and one of our other business is stock administration platform, and on our advisory board is very talented. Technically, we used to be their client, and he said, you know what, you do all these valuations for your companies. So, if you issue stock options, you need a 409 evaluation, and 409 evaluation is a tax code. So that's practically based on so the valuation is based on multiple principles. And what you do is that you come up with a price, and you can issue stocks. And we became number 2 in the United States. So we do roughly $2 to $3 billion monthly in clients' asset valuations. And we gathered all the data. And so we have an equity valuation company on one side, and the Neobank on the other side. And we're like, you know what? So, since we do so many valuations, why we don't start with a venture debt funding? So that was one of our first product, or it is our first product we'd like to launch. So the innovation always comes with 2 proposals. One traditional component, just ordinary banking. That's actually what we do right now. And the second would be venture debt, but the venture debt would be based on something which already exists. But marrying this together will give us a nice.
Okay. Lars, how is the growing influence of fintech startups affecting the competitive landscape of the business banking industry? I'm sure you can talk a lot about that.
I can talk a lot, I can make it short too, but the biggest difference in what we do with Mbanq is we break down the typical bank in different areas. It's not about the bank anymore. The service a bank delivers, not needlessly has to be directed at the bank. It can be anywhere else. It can be where the consume happens. Look at Uber. Uber is one of the biggest payment providers in the world, because every minute there are more than 3.5 million transactions on Uber payments. And all this would say, okay, this payment has to be settled by a bank, but now Uber does it directly themselves, right? With Mbanq now, we started as a provider for core solutions, then we became a bank as a service provider. We have our cookie cutter to division of neobanks. Then we do now embedded banking. We trade the services, bring them directly to the origination. And our latest step is towards brand initiatives. So we go for big brands out there. Think about having a sports club, a sports team, which have now their own bank. What can they do with it? Of course, it's loyalty with the customers, you bring them on board, but it gets much more than this. Think about the New York Jets. If they sell their tickets, well, either they pay 2.5% to Visa or 4% to MasterCard for every transaction, or they have their own bank, and now suddenly when the fans bank with them, they earn money with every ticket sold instead of paying high funds, right? Another part of it might be offering tokenization of players. So if you have a tokenized player, let's say the player has a value of 30 million and 10 million out of it you can tokenize, and then the player right away cash it out. So the player gets money, the New York Jets would get the money, but the fans could contribute with buying those tokens and have a kind of a game character inside, and when the value goes up, their value goes up. So saying there's a lot of new things coming, and none of those can be provided by any of the old banks. They simply can't do it, right? They run on old IT systems. They have gray-minded brains. They are socialist brains, you would name it probably. But that's not what you brings it to those modern approach, what people want to consume, right? And you know, as young generations want to consume like this, they play like this, they're on the TikTok, they're on the Fortnite games, they play in the PlayStation, they want to participate directly instead of going to the bank. Right?
So, Vlad, how can Fintech and the traditional banks collaborate to create a more robust, I would say, banking ecosystem? I mean, what are the challenges and opportunities associated with this collaboration? Or is there room for collaboration, or this is war, a zero-sum game? Because, I mean, the bigger bank, more power, more monopoly, they're not gonna let some tiny little firm challenge their position of power, etc. Or maybe there is room for collaboration depending on who's running these fintechs, obviously. So if you could elaborate on this, I would appreciate it.
Thank you. That's a great question. Well, that's true. The big banks have all the money in the world, right? They have so much money that, you know, where you and I, Ziad, and everybody in this room, when we put all of our net worth together, we don't even shift the needle.
It's not even their money.
Well, that's another thing, exactly. So, but then they don't see certain market segments that young companies and fintechs can see much better. Like, for example, here we have representatives from Qorbis and from Cheqly, our clients, that we really appreciate, and we're proud to be here with them. They provide services to a community of entrepreneurs that's traditionally been underserved by banks. So, for example, even Bank of America, they don't have a compelling product for small, medium businesses. They don't have a product where they can lend against their capital structure. They don't have a product that they can help you with receipts and expense management, things like that, right? So unless you are a huge corporation where you have a separate relationship manager at Bank of America that they can do something completely separate for you, you're absolutely not even on their radar. So therefore, of course, there's a room for collaboration. Now, why is that? It's because these companies like Cheqly and Qorbis and many others, they're eating those big banks' lunch, right? Which is good, right? So they're creating value for themselves. But at the end of the day, like what Tomas was saying, they still need money to be able to lend out, right? And the money sits with big banks. So you still need to collaborate at least with them as capital providers, or to be honest, you know, quite frankly, you need an FDIC insurance in many cases, right? So then you go to slightly smaller banks who are absolutely happy to attract new deposits and provide sponsorship to programs. So clearly this collaboration needs to continue. And to be honest, like what Lars was saying as well, even Uber, anybody else is now their own bank, essentially. They have so much by way of transaction volume. But at the end of the day, they still pay salary to FDIC-insured bank accounts. So whichever organization a person works for, they can only receive their paycheck in FDIC-insured or NCUA-insured bank account. So at the end of the day, you know, we're still touched by the traditional banks. So you still need to have some kind of sponsorship or some kind of relationship with traditional banks. But as far as marketing is concerned, as far as trying to get to those consumer groups that otherwise are inaccessible to those banks, is of course the startups and the younger companies and very successful companies like Qorbis and Cheqly.
Anybody wants to elaborate a bit on that? Go ahead, Steve.
I mean, to follow what you're saying, Vlad, I think as well, it's about, I think you touched on it. Big banks don't listen, okay? They've got what they've got. They're working with legacy systems, many of which have been held together metaphorically by, with tape, for decades. And so the business risk for wholesale migration to lean, agile, new tech platforms is frankly too great. The risk of failure would be catastrophic. So they just keep going. But the problem is that these banks actually, by doing that, by maintaining old legacy systems, rather than facing the business risk of a wholesale migration, actually they're just making a bigger problem further down the road. Because at some point the tape will not stick or it'll break. And I think where fintechs and companies like ours, by ours, I'm talking about Cheqly as well, of course, we listen. And there's no point in providing services that people don't want. There's only a point in providing things that get used. They get used because there's a real need for them. And that's how we make money. And it makes our customers' lives better and therefore more efficient. So I think that's one of the kind of, I would almost call it a cultural difference between fintech and traditional banking. But you're right, we need somewhere in the mix, these banks. And I think also, we touched earlier on the new sort of breed of entrepreneurs, tech-savvy business leaders. A lot of these people have actually some distrust actually of large institutions because, of course, what happened in 2008, which is recent history, really, was largely the fault of bulge bracket banks, right? And they would rather look on a phone app with a name that is backed by an FDIC bank than deal with that bank. So there's no loyalty.
Got you. So what's the most critical element there? Is it people? Is it access to money? Is it creativity? Is it big yachts to go to war? Well, there's, how do you really differentiate yourself on the back? How do you differentiate, one second, Tom. You can answer this question. How do you differentiate yourself on the back? A lot of entrepreneurs, they have nice ideas, etc. But more, it's like a lifestyle. They're making good living. But how do you really make a compelling presence and really start to threaten the banks in a way whereby they're really going to buy you or pay you an obnoxious amount of premium to acquire you, to shut you down, or to shut the fuck up? This is all war. We're not here to talk theory. We're here to talk, how do you really impose yourself? If you have the experience, like all of you guys, if you have the money, more money would make a difference, more people would make a difference. What kind of people would make a difference? Nice, compliant people, or real shark entrepreneurs? What will it take to get the big banks' attention and to be a real game changer? Because this is what matters. The rest is for the birds. This is not academia here. This is not Harvard Business School to talk about theory. But in practicality, how do I really take a big chunk of the big banks who are born more and more, acquiring more power, more influence? If each one of you can elaborate briefly on this, this would be very helpful, because I'm sure there are some entrepreneurs here who want to start their small fintech, or who already started their small fintech, or who really wants to... Look, the most important thing is time here. If you want to spend this time of our life on this enterprise, what will it take?
Ziad, I can take that one.
I'm sorry, there's too many questions.
No. It comes to time. It comes to time.
Okay, go ahead.
So I can give you an example, right? So we have a Hong Kong license, MSO license. So we force the regulator to practically accept us as a neobank. We just basically gave them like, hey, look, we're gonna do what we were gonna do, and just accept us. It took them 1.5 years to accept us as a neobank. We shouldn't say, by the way, neobank, because we are not a neobank, but that's what we said. It's what we
I mean, you remember?
So,
Tom,
yeah,
you remember
it's time.
we were in discussion, you and me. I wanted to buy a bank. You remember? It was a nightmare.
Yeah, it was nightmare because it's great. So I have a very good compliance officer, and what I have actually learned is that you don't make a friends with a regulator, right? They just technically by default they want to decline your application, but you gave them enough of information so they approve you, it's time. So Ziad, so you were asking multiple questions, but I think it's you can't really rush any regulatory approval, and money are regulated, unfortunately. So we are regulated in Hong Kong, we are regulated in the United States through practically Mbanq but it's time, and I have numerous friends in Hong Kong, in the United States, and they always call me like super desperate. Hey, what's going on? And I always keep telling them the fintech, banking, or anything related to money, you need to have 2-3 years. Whatever you want to achieve, it's always about the time, unfortunately. And there's a shortcut. It's definitely a crypto, right? But that's for a different discussion. And even though, anyway.
So basically, it's run and dictated by the regulators, no matter who you are or what you do. That's the bottom line. And the regulators are the same all over the world.
You need to play the game.
You need to play the game.
Let me add to this.
Go ahead, Lars.
The regulators is the problem here. The regulators tell the people they are there to save their money, right? But matter of fact, they're there to save the socialism. And the way out is clearly cryptocurrency. I was 4 years in Angela Merkel's innovation forum for banks. And those days, the biggest discussion was how do we get rid of cash? Because cash, you cannot control cash. As long as there's cash, it's difficult to get control of all people's cash flows, right? So it was 2011, 12, 13, 14. And then somehow this development of the cryptocurrency came up. And they quickly recognized if the cryptocurrency is there, there's an exit for the cash. So even if they make electronic money, there's no control. So this discussion was stopped with taking cash off. So that's why there's still cash. But the problem is the regulation, right? Period.
Okay, Vladimir.
There's a lot of questions to untangle. So I would say we do have to play by the rules, by the way, and so that's unfortunate, So at the same time, companies like ours, we survive because our competitors did not appreciate that. They didn't appreciate the rules. They thought that we're rookies, we're cowboys, we will go ahead and do it.
Yeah.
In fact, we come from technology, we don't need to understand the banking, we're going to untangle the banking and we'll be successful. Where are they now, right? Yeah. So you have to appreciate, you have to appreciate the regulator. You need to understand that they're also professional at what they do. They might have a different agenda to yours. But at the same time, what makes us different here in this room is that we look for opportunities. And our outlook and the way that we look for opportunities is somewhat different. We know how to make money by listening to people, just like what you said, Stephen, right? We make money by finding the niches where others are not playing.
Yeah.
And what's hilarious is that those big organizations and even the regulators sometimes, they don't know what is actually happening.
Yeah.
Right? So we can make money under their noses, essentially, if such expression exists, right?
Yeah.
So we can make money, we can continue being successful without them dictating to us what we should and shouldn't do. And we do this by collaborating, by working with like-minded individuals, not crossing the line. We're not here to upset the regulator.
Of
not
course.
At all. We're still playing within the game, the rule book, right? But at the same time, we're always open to opportunities. And we materialize. We actually make those opportunities happen. We come to events like this. We network. We find like-minded individuals, and that's the key for success.
That's awesome. Steve, go ahead.
Yeah, I just want to add to that. I mean, you said we're kind of eating some of the scraps from the table. We're nibbling away at the lunch of traditional banks. I think they're too arrogant to even recognize that that's what's happening. But in fact, because there might be some quite large fintechs who are sort of challengers, but what they haven't been able to do is assess the risk of if you want to say, the aggregation of all the angles within the fintech industry that is taking, various elements away from the traditional banking model. Because if you put all of those in aggregate, that's quite a big piece of, because it's global, right? It's not just here in New York, not just here in the US. I mean, it's a global thing. So that was one of my points. I think they haven't figured out that actually somebody is, eating their lunch. They haven't spotted it. The second point, we talked about regulators. It's a little bit of a conundrum because, regulators here in the US behave very similarly to the regulator where I come from in the UK, Financial Conduct Authority. These are in developed economic environments are called competent authorities.
Yeah.
Okay. That's how they're characterized. And they've got a sort of conflict of interest because on the one hand, one of their stated aims is to help increase competition so that, it goes against the kind of monopolistic ethos. But at the same time, they don't want, a plethora of new applications of things that frankly they don't understand because they're ill-equipped, because they're not fintech people.
Yeah.
So they don't know how to assess the risk. So it's easier to say no, because you can always find a reason, right? There's always going to be something wrong in the application that they can zero in on.
Yeah.
So it's easier for them to say no than yes. So you're right. That's their kind of starting point. I think that was the point you made, right? Their default position. But at the same time, they have a charter. It's publicly stated that they should approve an application unless there's a very good reason not to, number one. And number two, as I said, they are there to stimulate competition so that it doesn't create a monopolistic environment. So there's a conflict of interest, definitely, with the regulators. And they are, the FCA in the UK is like 4,500 people. Okay, and they're the regulator. And they regulate banks, investment firms, fintechs, insurance firms, and some others, okay? And they're understaffed, inverted commas. They claim they're understaffed. So their turnaround times are just like, a year, maybe a year, 2 years. So again, Tomas's point, if you're thinking of getting into this space, you're in for a long wait, but you've got to work at it. And there's not a lot you can do to make that faster.
Thank you, Stephen. Yes, Tom, you had something to say.
I have actually a very funny story, right? So regulators are slow, we are very fast. And when we were applying for a MSO license, I have a few companies on the shelf. So if I want to do anything, I pick any company I have on my list and I apply for the license very fast, right? So we had the company was called Startup R Books Limited, books. Yeah, like the books, right? And we applied for the MSO license. And we were in the process for roughly 14 months. And Mr. P, he called us and was like, so when are you going to publish? And we were a neobank, right? Like, so the business model was very simple. We receive money, we send money, we deposit money. And after like 15 months, 16 months, he called us just before we were supposed to get approved. And he was like, so when are you going to publish your first book? And I was like, book? Like, what do you mean? We are a financial authority and we don't really publish books. We are like, so, so the message is that sometimes, and that's like in life, that people will try to confuse you, not like consciously, they are confused, the regulators are confused. So they gave us a call and so my staff was like, so when we are publishing books, I'm like, books? I'm like, I don't write books. So we came up with the idea that, you always have to think of like how to get the narrative down to the regulator. So we came with a DBA, doing business as, so we came up with a different name, Cheqly. And like, yeah, we are neobank, like we do, what we applied for like 16 months ago. We don't do books. You don't control you don't do any censorship or whatever. So we are your financial authority, and yeah.
Thank you, Tom. I appreciate it. I'd like to congratulate you all on your successes and your achievement despite this very competitive, challenging environment. That's amazing. Your creativity, your relentlessness, your commitment, it's amazing. We'd like to see more people like you. Anyway, I'd like to turn the questions to the audience. I spoke enough. You have half an hour to address any questions you want. The thing ends up at 8:30, so please please, no comments, just questions. Some people go stand up and making comments. One second. Start with Anthony. I'll be back to you. Anthony, please stand up and take this. No, I can take this. Please, thank you.
So as prominent people in the banking industry, what would you guys say long term that Grayscale launched their Bitcoin ETF and the whole way the crypto market is changing within ETFs and other types of bonds and other types of ways to invest? Now, how is that going to affect the overall industry?
Well, I can start, right? Now, let's put it this way. Right now, it's a taboo subject, and even the terminology itself is a bit of a taboo, right? So we try not to use it very much. But that's not to say that the technology that we have propagated or created and implemented does not support that, right? It does support that. In fact, we were always ready. We've been working in that industry for a long time. And then when it all of a sudden became a word like a C word, right? That you can't use anymore, So we just don't use it, We're just waiting for the tide to shift that we can come back to the same as we used to. So, and that's in the United States, but elsewhere, for example, we can, where we are not restricted, we can still continue doing it. So you go, Lars.
And we do it.
Thank you. You want to address? Go ahead, please.
Yeah, I think it's also important to make a differentiation between digital assets and blockchain. I mean, blockchain is a very elegant, very efficient sort of transport mechanism for data, right? And that definitely has a place in our world. The digital assets that can transact on those blockchains and smart contracts. Again, some have an absolute use case, and you can, real estate investment, for example. I know there's been a lot of real estate plays around smart contracts, and we get that. I mean, if you're talking about trading of digital assets, yeah, you're right. I think there was a lot of activity in that. It got a little tricky, like a year ago or a year and a half ago. We're sort of just waiting for that to become a little easier to digest, but certainly the technology supports it.
Yeah, by my Steve. I think it comes down to one thing is about the risk, and me as the founder and CEO, you either choose a crypto, and you might end up on the sanction list. It might happen, right? Because I can't really understand until now how I understand that obviously, but the problem is that at our neobank we have such a big problem to move $1,000, $10,000, right? Because we have a transaction monitoring system, and there is one transaction, and we need to investigate what's going on, right? And then you have a crypto, right? And the crypto trillions dollars left and right. I'm like, how is that even possible? Right, and especially U.S. government makes sure that they lead or punish one simple company, and makes that as an example, right? And me as an entrepreneur, I would rather choose the safe path and wait for the right moment until the regulations are in place, rather than just get hit by the sanction and be on the list forever.
Okay, thank you, Tom. Let's keep it because there are a lot of people who want to ask questions. Yes, you had one. Go ahead.
Yeah, in a similar vein to Anthony's question, my curiosity is not about the trading as much with the crypto, but the transactions. with a product like XR or technology like that. So your thoughts on that? XO.
I would say that generally speaking, the technology has moved on so much that you can theoretically express almost any transaction through blockchain or similar technologies, right? I might not necessarily be familiar with what technology that you're referring to, but it does exist. It does take place. Now, the point that we were trying to make here on this panel is that you might still be doing this somehow, right? You just don't call it the words that the regulator would otherwise find offensive. Let's put it this way.
Yeah.
So that's the kind of theme that we were trying to deliver, right? And so at some point in time, when the tides shift, then it all comes out. It becomes again the same playing field as we had, let's say, prior to the FTX collapse, for example. So when the industry was flourishing, there was a lot going on. There were summits, there were events, very high-profile events, and there were certain jurisdictions that were making money on this, Now, they still probably continue making money there, but then the regulator in the United States here almost explicitly does not allow us to even communicate about it, So that's why, yes, the tools exist. We love the tools, and we just wait for this veil, of lack of acceptance to disappear. And then when it does disappear, then we will come out again.
Thank you. Yes, you had a question here.
About this background, now that Fintech is out of this favor, but you guys, people like yourself, Fladimir, and both for Mbanq and the Mbanq question.
Well, I can start.
Did you hear what she said?
Yes. So basically, the question. I'm assuming the question is about VC. So now that VC has dried out, how do young companies? It's not their favorite. Got it. Well, I can tell you that from our perspective, from us being a player at the intersection of banking and technology, VCs were not our favorites, so we never actually pursued to fundraise from VCs, so because if you look at us right now, we don't have any random or aggressive VCs on our board or on our cap table. We actually fundraise from friends and family to get going, and all of the people who joined Mbanq, they had to bring their own money to get us going. This is why we have quite a number of co-founders, but everybody put their skin in the game,
Yep.
in the vein of
That's the only way, absolutely.
Right, and so if I were to do it again, I would do it exactly the same way, right? You get everybody at the table, ask them how much they can invest themselves, and it doesn't matter if they can only bring, one paycheck, that's also fine. They have skin in the game. Now, we explicitly did not want to deal with VCs from the get-go, because oftentimes when we had interaction with VCs, they would take a lot of our effort, they will take a lot of our intellectual property, and then, they might not explicitly use it elsewhere, but it will inform their investment decisions going forward. So at some point, we just realized that, why are we wasting our time? Let's just go find like-minded individuals, those who have deeper pockets, much better understanding of what we do, and more importantly, much better trust and belief in what we're trying to achieve, and not looking at the exit horizons, not looking at replacing the management team or introducing their own accounting practices or things like that, right? So I will say that we haven't really pursued that. I don't believe that, I don't believe generally that VC model is something that is sustainable in the long term, because they are in conflict with entrepreneurs, because entrepreneurs want to build a long-term sustainable business, whereas VCs, they have an exit horizon, and God forbid if you enter their fund and they have 2 years left or less.
They don't give a hoot about entrepreneurs.
Sorry,
I have a lot of experience with them. It's all about them, their ego, their agenda, etc. This is a very smart decision you're making, Vlad. Of course he can. He can go to family offices who writes much bigger checks than VCs.
So otherwise it'll be just me answering. So you go ahead first.
It's a very good question, and it is an issue. And our approach at Qorbis. I mean, we're pretty early stage, relatively speaking, but our approach would be to go to what I call strategic investors. So what does a strategic investor look like? So this is obviously somebody who wants a return on their capital, but it also fuels something that they have as a natural kind of activity. So we've engaged with some groups who are sitting on investment funds that also have access to large pools of users, potentially, through whatever relationship or structure they might have. And we found that we are particularly interesting to them because not only can they invest and essentially, get equity growth and upside, but it facilitates something that they're already trying to do, which might be to monetize, for example, a group of like an affinity model. So, they might have an association or an underlying customer base of many thousands of users, and it enables them to monetize it. So that's our kind of approach. We started off with a little bit like Mbanq, friends, family, and people we know, and money that was, should we say, close to us to get us started, but we're now looking very much at the strategic investor route. Would we go to VCs? I mean, we won't say no to a meeting, but I share Vlad's point very much. I think it can be quite exhausting or exhaustive. It takes a long time. You set up a comprehensive data room. It does educate them and inform them about something that we've taken the time and trouble to kind of know about, with no guarantee of investment at the end of it. And then if you do get that investment, you are then in that difficult situation where typically the VC will want to be able to see an exit point, which may not align with our growth.
Thank you, Steve.
Very good question, by the way.
Well, we have a lot of
like I have an analogy of being a guest in the restaurant, right? So I was always raising money, and I'm in the restaurant, and I see like everybody's eating, and I was like, hey, can I get the same meal, right? And I have probably more. I can pay more for the steak. And we never raised money, so I came up with the idea that I would turn the company profitable, which happened this last quarter. We're raising money right now. We got a term sheet from VCs, but the strategy would be to raise enough so I don't give up 20% of the company. So I have a strategy how to practically make money to ourselves. Very pragmatic, but overall, we are entrepreneurs. We go where we have to go. It's what we do, and there's no really recipe for how to get stuff done, right? We are not Facebook founders, so we have to get what we have to do.
Tom, you remember the number of times you called me cursing VCs, frustrated about VCs, telling me how stupid they are, telling me how moronic they are, how big their ego is.
It's irony, yeah.
And I always remind you, stay away from them. They are vultures, whether early stage or later stage. They are the most incompetent, egotistical people who ever existed. And I have a lot of experience with them, believe me. They are, except for 1-2%, the really top, who keep performing, raise fund 6, 7, 8, 9, but all the younger crowd with their fund 1 and 2, run by a bunch of egotistical Ivy League graduates who never operated a company, who don't know how to make money, who never made money, and who make their money on fees. This is public. They are the most stupid class of investors I ever encountered, and I've been in the investment business for 35 years. Thank you. Unbelievable. VCs. Unbelievable. Yeah. Okay, next question.
If I may.
Go ahead.
Okay, so my question is more big picture, so it could be fun. I've heard today that there is a lot of necessity with FDIC insurance or similar insurances abroad. And technology is disruptive technology. So, taken from you, Ziad, how can we usurp government, maybe pull the rug out from government, fuck you to government, and
I like the way you
potentially
think.
disrupt the FDIC insurance value model?
Well, you have to be careful. I answered the question in a different format, and Vlad answered very skillfully. You have to be careful. These guys are very dangerous. You know what they can do. So no matter how you hate them, I hate them more than you do, but you have to be very dangerous. You have to outsmart them. You cannot threaten them, you cannot do this. They're very, very dangerous. So, I mean, I understand, I sympathize with what you're saying 100%, and I'm sure a lot of the panelists here do the same. But Vlad and his partner here would not have survived this long if they did not act this way in a very smart way to navigate through this maze skillfully. If not, they would have shut him down. He's an immigrant. No, I mean, it's true. You don't think they look at that shit? Of course they do.
So deposit insurance is what is sought after. So how can we privatize it, democratize it, and
You're
provide
dreaming.
the same service competitively?
You're dreaming.
Is it insurance?
I talked since you're about, I built my bank in the space. Space is free, there's no regulations. Build my own currency, fuck you.
Yep, I agree.
And also, I would just say, if you look at it from a different perspective, the game is rigged, right? You understand? So you can do everything you want, but there are only two nationally recognized deposit insurance providers, which is FDIC for banks and NCUA for credit unions. So you can do everything you want, but at the end of the day, an employer cannot deposit a paycheck into an account that's not insured by one of those two organizations.
Yep.
Except
So that
pay the money in the bank, in this place.
Well, but then the money has to be in some other form, right?
Exactly.
So
There's always
there's
got to
some
be a lender
ether,
of last resort.
vapor.
It must be your own currency, right?
All right. That's it for the question. Or it's very hard to answer your question otherwise, because
I
look,
agree.
at the end of the day, I would just say that there are so many opportunities if you look at it, right? So let me give an example, opportunity with the insurances, for example, right? So let's say the FDIC insurance only covers deposits up to $250,000, right? Therefore, a lot of banks, especially those who provide services to high net worth individuals, including, by the way, Silicon Valley Bank, they have a very large proportion of uninsured deposits, right? Because they're above 250,000. So an opportunity exists that companies like Mercury, for example, I don't know if you've heard of Mercury, you must have heard of Mercury, right? So they participate in various arrangements where the deposits are actually sheltered by other financial institutions, so they can provide insurance potentially. They're saying they can up to $5 million, right? Of course, FDIC would never comment on that, right? If you ask them a question, they wouldn't provide a comment. But at the same time, from legal perspective, it appears as if they've cracked, the code. So what Ziad was saying, that there is a way to navigate yourself in that complexity, and there are certain rules of the game that you just don't want to cross. Just don't do it, because, it'll be better for yourself, for your family, for your company. But at the end of the day, you can still be successful. And even if we eat those breadcrumbs, from those, big banks, it's still a lot of money. It's so much money that it's enough to create wealth for yourself, for your family, for your grandchildren.
Generational wealth.
Exactly. So it's better for all of us just to focus on that, and it's better for our emotional and psychological well-being.
I think also just to add,
The number one rule in the 48 laws of power, never outshine the master. Never outshine the master. That's the number one rule in the 48 laws of power. They are the master. Never outshine them. Go around them.
it's just kind of add, there always needs to be a lender of last resort. If it's at this level or this level or this level, so you take that one away and it goes to that one. So it always has to be like the safety net. The problem with trying to sort of privatize, if you will, the insurance element that we refer to here is that if you privatize it so it essentially becomes an insurance company, whether it's public or private, whether it's traded on the stock exchange or otherwise, it still needs to keep its money somewhere. So where's that? That's with an FDIC bank somewhere. Yeah. So all you're doing is putting an intermediary layer between the two, as I see it. But it's a utopian situation, you're right. I mean, what they've got in the UK is we have the government, and then we have the Bank of England, and the two are, the PRA, the Prudential Regulation Authority, is aligned to the Bank of England, and the two are somewhat disconnected. So they work autonomously from each other. So the government does not influence what the Bank of England does.
Can I just add one more thing?
Of course, Vlad.
I just wanted to add. Actually, it's a very thought-provoking question. You know, I can tell you why. It's because our mind is always channeled towards creating something within the parameters of our capabilities and the environment we operate in. But I can also tell you that the United States. Sorry, I'm not talking about England at the moment. But the United States is the most lucrative financial services market in the world.
By
right?
far.
By far, right? So if you start understanding as to where this comes from and why is it so stable, why does everybody want to carry a United States dollar in their pocket anywhere in the world, anywhere you go, right? So United States dollar is still there, and without going into politics or history or anything else, maybe not China, but so without going into all of that, right? There are so many opportunities now that you're here in this lucrative market. You can find a way, you know. So if you put your mind to it without trying to not just disrupt, but eliminate the system that makes this market and this industry so lucrative, but actually working within it, and you will be successful.
Exactly. Right on the money. Any more questions? Yes, Tim.
Okay, I'm not from this industry, so this may be a naive question, but we've seen in other events that certain industries and certain people get deplatformed. And I mean, like, for example, the marijuana industry has tremendous difficulty finding banks, and maybe that's eased up a little bit. I have some friends who are worried about political opinions. I mean, for example, if you're a Trump supporter in Seattle, you might have protesters coming after you and protesting your bank.
Yeah.
And the banks are very sensitive to that. A bank like what you guys form, how independent and insulated are they from those kinds of attacks? Good question.
Well, am I taking this question?
Yes, please.
So that's true. When we had when Donald Trump was the president, we saw a substantial growth in our business, and I don't attribute it to anything in particular. Maybe because maybe there were a few people in the government, you know, and things were a little bit faster. Maybe, but we all need to not look at that, you know. So if we start thinking about, okay, well, you know, are we politically correct or politically incorrect, you know? So we have very strict rules which are given to us by the regulators, you know, and the regulators, they're apolitical. You know, well, okay, I don't want to go into the political subject, but the regulator, so, and there are way too many regulators, right? So, but if you embrace your BSA compliance, and this is really the rules that really help us survive, is BSA, Bank Secrecy Act. And if you understand this, and if you understand how that works, irrespective of what political environment we operate in, because that is something that supported the financial system for over 100 years. So, and it's so strong that irrespective of what changes outside, you know, of the semantics or the facade that you would put in front of a, you know, financial institution, you know, the same Qorbis, Cheqly, it doesn't really matter. As long as you are upholding to the compliance standards, and the compliance standards are transparent to whichever government is in the office, then I think that this is really the only way to survive. We don't support any political views, and we stay away from those.
Look, at the end of the day, Tim, they are in the business of money. They're not in the business of activism. You can talk about capitalism, patriotism. It means that you're not a socialist, without endorsing Trump, without donating to Trump. This is what they look for. But if you write an article or something about preaching capitalism, what fintech, how much fintech has impacted the industry, has elevated capitalism, so what? I mean, they're not going to come after you because of that. You're in the business of money. You're not a non-profit. You're not an activist organization. You're not lobbying. You're not a lobby. You're not anything like that. So there is also a fine line here as to how you say it. You can't be that blunt about it. But I don't think one should worry about it.
Well, I guess my point was, Citicorp would be subject to public relations. If you do something so controversial, Citicorp might kick you off of out of their bank.
Yeah, but you don't work for Citi. Yeah, but I mean,
Are there pressure points that Citicorp can use on one of your banks that would cause it to have issues?
Well, I can also take that one. So all of our issues are connected again with compliance. So it just so happens that most of the fintechs, they try to address the segments of the market that are otherwise inaccessible for big banks, and oftentimes it happens to be long tail of consumers, the long tail, right? So it can be Hispanic community, underserved, or it can be immigrant community. It can be anything. Business banking is also underserved. So because of that, oftentimes those communities are underserved for a reason, and one of the reasons is because either they don't have documents, or maybe they've never really been exposed or educated in the financial services, and that's actually a big issue generally in the United States, that financial education is somewhat lacking. So there are there are certain communities that fintechs and brands are trying to attack or penetrate that are not the most welcomed by banks, and so banks can potentially shut us down or shut them down, if they're saying, well, look, you're participating in this Hispanic community, but this community is mostly undocumented immigrants. And the bank, for example, will say, well, we only allow about 10% of our balance sheet exposure towards that community, and therefore above that, you can't do it anymore. Or the same for students. We also work with colleges and universities. A lot of students don't have a social security number when they just start their university, right? So we have to find a partner bank that will allow us to onboard students before they have a social security number. So these are the impediments, I guess, for our business that a bank would impose on us, a partner bank would impose on us. But I think beyond that, nothing political, nothing else, I would say.
Let's quickly spin this question the other side. I told at the beginning I was member of the board of Deutsche Bank. So from a big bank perspective, it's much more complicated to stay compliant than for a neobank. Big banks have an issue. They have so many things going on. They have old systems. They don't even know trust their own data. They don't know what numbers are there, right? While a neobank is built on technology. Now, when was the first computer built? 1957. Konrad Zuse, Z1 was the name of it. Most banks are running technologies in the 60s, 70s. That's Stone Age behind, right? It's not even pre-internet, it's pre-TV, right? And with these systems, you cannot get the accurate numbers out. And that's why regulation was getting so much tougher and tougher in 2008 after the financial crisis, and now again after the last crisis, the new crisis. It will get tougher and tougher because no one trusts the data out of there. While the neobank runs different, right? We have modern data, single point of truth.
I'd like to give each one of you a minute closing remark, starting with Vlad, please.
So just one thing I would like to say, I liked all of the questions. I specifically liked the question about VCs and how to get funded. And I'll just say one thing that I would give a piece of advice for any CEO or founder in the room is that at any point in time of your career, as soon as you have decided to become an entrepreneur, you will be fundraising from that point until you exit your business. And you're always fundraising. You're fundraising at events like this. You're fundraising at dinners. You're fundraising on social media. So everything you do is fundraising. So prepare for a long journey. Don't take random people on that journey, especially those that come from VC world. But make sure that you always work with like-minded individuals, people who respect you as an individual, and people who want to work and be with you, as opposed to those who just want to give you money.
Excellent advice. Thank you, Vlad.
Something we completely missed out was AI today, artificial intelligence. I think that's a big future for all of us. And make things much easier, and banking will change tremendously like everything else. AI is the future, and we will all see it not only today, in the future even more.
Thank you, Lars.
My closing remark is that, we've spent this evening really sort of differentiating between the approach that fintechs take and where they position themselves versus incumbent, banks who are offering services sometimes reluctantly. But that said, the impression I want to leave you with is this: notwithstanding the traditional sort of financial model, if that's what you want to call it, the one thing that fintechs do take seriously, should take seriously, really must take seriously is compliance and regulation. Regulators are difficult, that's for sure, and compliance is burdensome. And frankly, it's a pain in the, it's 80% of the job is compliance. You don't have a lot of time for business development because you're always worried about compliance. But you've got to make it your friend. You've got to work with it. It's pretty difficult to shut down a large banking institution for compliance failures. It's pretty easy to shut down a fintech in a heartbeat for one failure. And, we talked about the risk of digital assets and, perhaps communities that, might bring financial institutions into disrepute. But there is a ton of sanctioned money washing through the banking system as we sit here today. And not least in the UK. I mean, we have a bit of a reputation for it. And it's scary. But, where does it stop and where does that end?
This is the best advice. Thanks, Stephen. Very, very wise. Tom, last but not least.
Yeah, I might add to it that we should never give up. I'd like to come up with one of my stories that happened just a month ago. We were supposed to lose one of our license, and the license was conditional. We were approved by condition that we have to pass the exam, and nobody was really able to attend the meeting. So we picked the smartest person in our company. It was a girl. She studied hard. She studied hard. Within 1 month, I was like, "There's no way we can pass the exam. There is no way." She had no idea about AML, compliance, nothing. So she studied for 4 weeks and she passed the exam. 4 weeks, it took her 4 weeks. So I think in our life, it's always never give up and find the best solution, the most common sense solution to any problem. So that's my remark to this event. And thank you so much.
Very nice. Okay, this comes to a close here, our event. Our next event is going to be on May 23rd, just for your information, mark your calendars. It's going to be on Bitcoin, blockchain, NFT, DeFi, all that kind of stuff. May 23rd here at the Pen Club.